All right, stocks hovering around the flat line at the start of a holiday-shortened week. The pause coming on the heels of 3 straight weeks of gains. Big tech has been leading the way with the Nasdaq recording its best week since June. So does this rally have legs? We want to bring in Drew Pettit. He's director of U.S. equity strategy at Citi. Drew, it's great to see you. So what do you think in terms of the momentum to the upside between now and year end? What does that look like?
Yeah, look, we have a 4,600 target for the S&P for the end of the year, so we're getting close to our target. But admittedly, after a softer than expected CPI print, we actually think you have pretty good upside versus downside risk-reward setup into the year end right now.
Drew, as we kind of near the Thanksgiving holiday, I continue to think about a lot of people that are going to go home. They're going to be sitting around the table, perhaps a few of them, and talking some of their investment strategy and some of the top takeaways from this year. Your top takeaway for the Thanksgiving Day table in terms of the equity market and strategy that investors can employ, what would that be?
Honestly, this has all been about a growth market this year. And if you want to talk about the past, talk about growth, talk about the Magnificent Seven, talk about AI. But if you're looking to the future, talk about earnings resilience. Admittedly, everyone's been talking about how bad the economy is or is about to be. But when we look at the fundamentals, we're actually really constructive looking ahead. So it's almost the boy who's cried wolf here when it's come to recession. We probably had this same talking point going into 2023 at this time last year. And then all of a sudden, we're looking at the S&P just came out of an earnings growth recession. And we actually think there's a lot more resilience ahead and probably a broadening of both market action and earnings growth under the surface.
Drew, what is that earnings growth, do you think? What does that look like more specifically then for 2024?
So admittedly, we're probably, not probably, we are a lot more bullish than a lot of our peers here. We expect, high single digit growth next year. And it's possible even if we have a recession. What a lot of people just don't realize is the stock market is not the US economy. And then on top of that, there's other drivers. And we think the biggest under-discussed story right now is productivity. Like we talk about AI from its effect on performance of the index this year, but think about as companies learn how to use this technology, both tech companies and non-tech companies, this is going to have an impact on efficiency in the bottom line, even if volume growth slows next year.
Does that also have a knock-on impact on headcount for a lot of these companies?
So look, talk to a lot of companies right now and they don't feel like they're aggressively overstaffed, and talk to their employees, they don't feel like they're underworked. So when it comes to staffing, you can do more with either the same amount of people or fewer people. It's a great way to manage cost pressures, especially on the labor side going forward. Like, look, you see this in industries that are more basic, like restaurants or basic consumer goods, retail, and so on, how they can get more efficiency by managing inventories better, making their workers more productive. And then you're going to see gains on the tech side and even in these more complicated multi-industrials where they can charge higher prices because there's a tech element built into a product, or they can manage more complex supply chains a lot better than they have in the past.
Drew, I know you said obviously the market's not the economy, but you did say something I do want to pick up on when it comes to the odds of a recession, because you said that you still see high single digit growth here for earnings next year, even if we do see a recession. What's your base case for that slowdown?
So our Citi economists expect quarter over quarter GDP growth of about -2% in Q2 and Q3. So that's the house call. But where I like to tie this back to the stock market is that's not how we talk about earnings growth. We talk about earnings growth in year over year terms. So if you actually flip this around and look at real GDP on year over year terms, that's actually plus almost 1.5% in Q2 and barely negative in Q3. So a recession in economics terms, when you translate the math to how we speak about equities, actually isn't expected to be very deep. So our baseline, again, our stated forecast is 245 for S&P 500 EPS in 2024. But even if we do have this mild recession, even if we get our economics base case, our economics team, if their base case comes true, we still think you have mid-single digits earnings growth. And I think a lot of our peers don't really give corporates that efficiency argument. They just aren't baking that in right now.
All right, Drew Pettit, Director of U.S. Equity Strategy at Citi. Drew, thanks so much for taking the time.